Good afternoon, everybody, and welcome to our quarterly conversations, the second for this year. And it's been quite the ride for the first quarter. But since Dan's March newsletter that he put out, the end of March, the stock market, the S&P 500, has pulled back over almost by 5% since the end of March.
Yeah.
Um, U.S. bond aggregates still around negative 3%, I believe. And the yield curve, as we discussed, has remained inverted since June of 2022, which is 18, 19, 20, 21 months of an inverted yield curve. And I think one of our conversations that we had probably a little over a year ago, we talked about the statistics of the yield curve and how typically we would be in a recession within 18 months. And that dated back all the way to 1929, if I remember correctly. Um, but very interesting. We're not in a recession today. So Dan's going to go over the newsletter that he authors, and he's going to talk about the stock market, the economy, and the bond market, and then we're going to go through some expectations of where we're going and where we think we're going. It seems like everybody, every economist out there, every analyst out there seems to be still on different sides of the fences of where the market's going, where the bond markets, where interest rates are going. So let's walk through it, Dan.
Yeah, let's do it. And just to reiterate Rick's sentiment, thanks everybody for joining. And we look forward to these every quarter and hope you do too. I'm gonna share here. Uh, okay. So hopefully everybody can see this. So just a little bit of just sort of a review of where the markets have been so far. Year to date, Rick mentioned, I mean, so far 20 new all-time highs, and I think that number has been revised up a bit since the 2 weeks ago that I wrote the letter. 20 new all-time highs in the S&P 500, 15 on the Nasdaq, 16 on the Dow. We talked about this a little bit last quarter, but the theme last quarter we had talked about was strength begets more strength, and that certainly seems to be the case with where the market has been going. A couple of themes we've mentioned in past, and we'll get to the bond market a little bit, but how typically towards the end of interest rate hike cycles is when you want to be investing in bonds. And as we can see from bond returns thus far this year, that trade has yet to pan out. So has not come to fruition yet. Bond returns are still flat. This is not to be confused with if you hold a CD or if you hold a treasury and are holding it to maturity and are clipping that 5% coupon. Of course, you're getting that 5%. This is showing you your aggregate returns of the bond market. Compared with stocks, I mean, US large cap is up 10.5% just in the first quarter. Which has doubled small cap stocks, doubled international stock. Emerging markets is trailing as the dollar has so far remained fairly strong. And futures are actually doing quite well, with expectations continuing to be that stock returns will continue. So really across the board, just good results. And more strength as we've seen previously. The outlook here, this brings us to a kind of a precarious place. We've been talking about, and I still don't think that we are, not that we've taken a definitive stance, but I don't think that we are necessarily wrong that a recession is somewhere around the corner. We may just be early. A recession is always around the corner. It's just a matter of when and by how much. But when you hit this part of the bull market is getting a little bit long in the tooth, it's always, well, where do we go from here? We're having these conversations with clients every day of, well, what do we do now? Stocks look expensive, the market's up very high, and it's true. Generally, the outlook on U.S. stocks is, say, looking over the next 5 years, low to mid single digits annual returns, um, potentially not without disruption, right? Or volatility. Um, this seems to be a tale as old as time. International stocks, the valuation looks much better than US stocks. They look cheaper. Sometimes they're just cheap for a reason. So we hear that all the time, and I know Rick and I are always on the same page about this. We tend to have a strong domestic bias anyway. So even though
Well,
valuations look good internationally, we still tend to tilt US.
the
Uh,
valuations have been good internationally for the last 15 years and still haven't
right,
produced.
right, right. Which basically means cheap for a reason. Um, and ultimately, again, coming down to the bond side, um, yields have risen, and 2022 was a horrible year and worst year on record for bonds. Coming out of that, it looks like bonds are ready to take back over as far as ballast in the portfolio and return outlook. We'll talk a little bit more about that uh, in the coming slides. But let's go back to, again, this theme just continues to come back. And every single quarter that we look at this, it's just getting more and more concentrated. The theme continues to an even greater extent. So the top 10 market cap stocks as a percentage of the S&P 500's market cap, we can see we've hit a 50-year high again. Back to back to where it was in the 70s, back to when it was at the time it was the nifty 50s were the
Nifty
leading
50s,
stocks.
yeah. 50 stocks versus just 10.
Yeah, now 7 or 10, or this is the top 10. We talk about the Magnificent Seven, or I think 2017 when we saw that big run up, it was the FANG stocks, the Facebook, Apple, Amazon, Netflix, Google. So depending on how you slice it, same theme. Incredibly concentrated market. Most of the returns, if you are not at least market weight in those top 10 or 7 or 5 or whatever number you choose, if you're not at least market weight in those, which most diversified portfolios are not, it's hard to keep up in these types of momentum trade markets. And these tend to, as you can see from prior periods where this has happened, these tend to subside. That concentration tends to go away. It usually is not at these peaks for long, right? You see, go back to the dot-com bubble, and even back to 2008, back to the 90s, these tend to bleed out into the rest of the market.
So just a thought in 1998 to 2000, there was that concentration. There was one stock in that concentrated portfolio then that's in this concentration of top 10 now. Can you name that stock?
Well, I can. I don't know. I want to see if anybody can put it in the chat or the Q&A box. I think the chat's open. I wonder if anybody can guess what stock it is that's been around this uh, top 10 for the last 30 years.
30 years. Well, yeah, it dropped out a little bit when the S&P started becoming a lot more broad, but it was there in 1998 through 2020 or through 2000, and then it's there again now.
Yeah.
So I don't see any answers in the chat, but let's walk through the next slide, and then let's see if anybody puts the answers in the chat, and if not, we'll answer it for them.
Yeah, we'll come back to it. We'll come back to it. So, okay. So what this means for investments, not all that, it's not rocket science. We think that this means the rally will broaden out to the extent that the rally continues, and we'll talk about why that, why the strength could continue. But we think it's going to broaden out. So even if we just go back a year, well, this is technically 16 months going back to the beginning of 2023. Looking at those Magnificent Seven, the top 7 names, versus the rest of the large cap stocks, so call it the rest of the S&P 500. Typically, those larger names trade at a higher multiple, so 22 times earnings versus 16 times earnings back in January 23. That has expanded to, both are trading higher. Those other large cap names are trading at an average of 19 times earnings. The Mag 7 is trading at 30 times earnings. So the dispersion in the PE ratios suggest that one of two things will happen. Either the rest of the market catches up to those concentrated names, or the concentrated names are going to catch down. In other words, whether it's a bear market or recession or some sort of a downturn in the market, they would catch down to the rest of the market. We think that it's more likely that it would be the former, that you're going to have the smaller stocks catching up before any broader event happens. Although this doesn't mean we're going to have a rally, right? We talk about low to mid single digit returns. We just think the opportunity is in sort of the rest of the market outside of the S&P 500, outside of the large concentrated names. So I'm going to pause there. I know, Rick, you had some insight on this from, was it Morningstar that had the growth expectations on?
Yeah, so the growth, and that probably would take into when we were talking about corporate earnings.
Yeah, yeah,
The
yeah.
growth expectation on so Morningstar had stated that growth is expected to roughly even out. So with these top 10 stocks, they're expected to see about a 17.2% growth in earnings, while the other 490 stocks are expected to see a 17.8% growth in earnings. Now, that doesn't mean the stock price could fluctuate more or less than the other, but what it does mean is it means that they're both starting to even out. Where we had some substantial growth in earnings, especially when you look at Nvidia and you look at Netflix and a couple of the other stocks who are at the top 10, Facebook and the other one I'm gonna reveal, since nobody put it into the chat. The one company that was there in 1990 or 1998 to 2000 was Microsoft. Earnings were going up aggressively, but now are supposed to even out. One of the largest, fastest moving stocks in that top 10 was Nvidia, and that's actually dropped off 10% in the last 17 days to a month.
Right.
Has
Right.
dropped off about 10%, which basically I think you're going to get a combination, Dan, of some of those stocks starting to drop off a little bit, and the other 490 starting to pick up speed just a tad.
Yeah. So, and I think that the important thing there is if you have similar earnings estimates. So we were going to talk about corporate earnings, similar growth estimates. So this is comparing US, international, EM, but in theory, you're getting the same expected growth out of the Mag 7 or the market versus the rest of the market. Wouldn't you rather pay 19 times earnings than 30 times earnings if you have the same growth estimate? So the idea would be, if we assume that the market continues on with its strength, the opportunity is going to be more in value stocks, dividend stocks, is going to be more in small caps, mid caps, those that are not trading at the higher multiples relative to the broader market, and where there are, those that can perform better in potential economic slowdowns, higher interest rate, higher inflation environments. Similar theme to what we've been fundamentally talking about. It's just that this is, we've been talking about this for the last couple of years here. It proved itself out in 2022. The trade went back the other way, where these growth names all of a sudden shot up, and it looks to be at an inflection point again. So the markets are moving, very quickly. But the important thing to realize is that as far as just the stock market goes and the outlook, just because we're at a high doesn't mean that we can't stay there and continue growing, because this isn't just a pure speculation trade. The actual earnings growth estimates pretty much across the board, US, international, EM, are increasing, and in a big way, right? I mean, US earnings growth estimates for 2023, 1.5%. It's anemic. And 2024, we're looking at double digits. So I think that this is important to realize that it's not just investors pumping up multiples and pouring money in because they think interest rates are going to move down. More on that in a minute. It's actually there is real optimism on the street that corporate balance sheets are incredibly healthy, that earnings growth is going to continue on at double digit levels, and that a lot of folks think these multiples are justified. So I think that that's important. That not just walking the walk, talking the talk there, or not just talking the talk, walking the walk. Did I get that backwards? I don't know. Maybe whatever, both of
I
them.
think it doesn't matter as long as you're walking the walk.
So this is sort of the theme, right? This is what we're talking about. Kind of stocks continuing to climb the wall of worry. So typically, and I think this should not come as a surprise to most folks, bear markets and recessions tend to happen around the same time. It's not like an exact day where a switch gets flipped, but the period of a bear market tends to coincide with a bear market, meaning a 20% or more downturn on the S&P 500 or the stock market. Sometimes that'll lead a recession. You start seeing the contraction, and then a recession hits, or sometimes it could be completely decoupled, where you saw that back in the 80s. We actually saw that in 2022. We had a 25% drawdown in the S&P, although we technically never hit a recession, which is another reason that you would assume here that we're still trading sort of in that same cycle. We had this technical bear market in the stock market, but never actually entered a contractionary economic period. So we're still on that same trend. And if you this is obviously a much longer chart that we're looking at here, but if you kind of draw a line here, we're still on that same growth trend there, right? So we still have yet to hit that cyclical downturn.
And I think, Dan, that a lot of that had to do with going into COVID and completely shutting down the economy. Once we started coming out of COVID, people weren't going back to work. And
And I think you have to realize too, the other major thing that happened is two things. Inflation came back, which
mm-hmm.
we have not had real inflation since the 80s. Inflation came back, and interest rate policy was changed in a way that we haven't seen in a very long time, which we're going to talk about. It disrupted financial markets. The economy was still strong, but to be perfectly honest, investors just didn't know how to act in that scenario, right? Because it was a completely new regime change that we haven't seen before. And if you look back at what was happening in the 60s, 70s, 80s, when inflation and interest rate policy sort of were a bit unpredictable, those kinds of anomalies happened in the markets where things would go flat and sideways, and they'd react in ways where again, you had in the 80s here, I'll just circle it. You had a similar phenomenon. You had this bear market here. Where's the recession? That there isn't one. It didn't come till years later.
We call that Black Monday.
Yep, until years later, then you hit the recession. Right? There's a recession here. This is 90, 91. Well, that's 3 years later. That's 3 years later. You got back to where you were, and then you hit the recession. So, that we're talking about things that don't always make a ton of sense when you have inflation and you have interest rate policy doing things that are different. So I just want to bring that up.
A lot of that came in the expectation of taming inflation, because we were in a fairly aggressive inflationary mode through the late 70s and through the 80s. And we had inflation seemingly under control as we got into the mid to the late 80s. And a little blip in the market that indicated that maybe we don't have it under control caused that Black Friday, where stock prices dropped drastically, and I remember people jumping out of the windows of their office buildings in New York. That's why they put us on the first floor. Um, but which is very similar now. So inflation is not necessarily bad. Out of control inflation is bad, and right
Yeah.
now we seemingly have it under control. So we can continue to climb, um, and with unemployment where it is, and with interest rates now up, it's going to take a little bit of time for that to settle in, and we can
Right,
continue
right.
to have a bit of inflation, but not out of control inflation.
Yeah, I think this is a good segue to the inflation slide. There's this inflation. This is an interesting one because there's a couple of things happening here. It depends on who you ask whether or not inflation is out of control. If you're just looking at what the I was reading something that central bankers and economists, we tend to look at inflation in year over year terms. So Fed's target is 2%, right? And the headline CPI has been hovering around 3.5. Okay, so we're above the target, but if we think about it in terms of a percentage, 3.5%. So for every dollar that you spend, it's now 3.5 cents more expensive. Okay, that doesn't seem to be all that bad. Consumers tend to think about inflation in absolute terms. 2 years ago, that fill in the blank, whether it's a household good, a service, whatever it is. That refrigerator cost me $1,000. Now it costs me $1,500. That's 50% inflation, right? So it's interesting to think about it because consumers tend to think about this a little more cyclically in absolute terms, and you have this um, narrative, I think, out there, especially among consumers, that inflation is still high, even though from a financial markets perspective, it's sort of under control. There's a bit of a inflation has this weird psychological effect on people where the higher you think it is, the more you buy. Because that means you think that if you wait to purchase that item, it's going to be more next month, next year. So there's partially inflation, and the narrative around inflation has kept the economy going because it's sort of a self-fulfilling prophecy. If you have high inflation, it means goods and services are being purchased up. And if you think inflation is going to be higher tomorrow, then you're going to continue purchasing those goods and services, right? So even though we have largely gotten inflation under control, I would say my argument is there's a stickiness to it that I think most at every turn we see. And I think we're mostly on the same page about this, Rick, but I'm curious to hear your thoughts. It seems to me like we've been saying inflation is going to stick around at a higher level than whatever the pundits, the central bankers, the economists are willing to admit. It seems like everybody I listen to is like, yeah, we think we're going to get down to 2%. We're going to get down to that target. And the only thing left is shelter, right? So this particular chart shows the CPI X shelter, or the only thing left is we still have auto insurance premiums in there, or we still have these core
Strong
services and
employment.
whatever it is. And there's always the one other thing over the last 2-3 years or so. There's always that one thing that's sticking, and it's always something else. Well, we had food and energy. That's transitory. That'll go away. It did go away, but guess what else popped up? And seems to be this like whack-a-mole of you solve one problem and then this other piece pops up in the CPI headline, and we're settling in now to where we're at low 3%, low to mid 3%.
Yeah,
Um,
yeah, and
it's
and I think
possible we stick there.
yeah, I think the Fed's actually trying to push to two. And as we start to slide up a little bit, the market believes that they're not going to push to they're going to increase interest rates again, which they shouldn't. But I think they were looking for six points, six reductions this year. I think we started the year with, then we went
Yeah,
to three
yeah,
reductions, and
correct.
um, and now with some of the latest news that's come out, it looks like we're going to stay put unless politics reigns and gets them to push down interest rates by a quarter of a percent,
Right,
maybe a half a percent, but I don't think so.
right.
Um, but yeah, I mean, and we've been here before. I mean, this is probably more of a normal interest rate environment than where we were for the last 15 years. Because interest rates, the last time interest rates hit 2% was 1962, and then they've gone up and then worked their way back down over that time frame. So we're back to a normal average level. It's just going to take a little bit for the rest of the economy to catch up, and so we will probably run higher inflation rate, which is probably 3% for the next several quarters to couple of years, maybe,
Yeah,
before they can actually pull that back down.
right, right. Yeah, and I think the other thing that's important to note with this, with inflation and how I have the numbers here. The GDP growth, uh, uh, fourth quarter of 2023, annualized terms, real GDP, meaning above inflation, grew 3.4%. Right. So really doesn't matter what inflation is when you adjust for inflation and you say we have positive GDP growth. That's the sign of a healthy economy. We know that most of the economy is the American consumer. I think the exhaustive signs you're seeing is most of the pandemic savings have largely been spent, and you're starting to see delinquencies rising. They're by no means at like alarming levels, but they're back to trend level, right? So like the whole like American balance sheets are really healthy. There's all this excess cash on the sidelines. That has largely been filtered back into the system at this point. So where the inflation is coming from, if it sticks, is mostly from a strong labor market, which is still very strong. But the wage growth and unemployment, wage growth was at a cycle high, unemployment was at a cycle low. While they're still strong, they've kind of come off those really, really strong numbers and started to trend the other way, but we haven't, we're still in the early innings there to see if that actually continues. So, the question with this is, uh, uh, how much longer do we have, and what's going to be the other shoe to drop on inflation? Um, Expectations on rates, I think, are dictating a lot of this. And this is just showing you over the last 3 months, which is pretty insane. I'm going to just circle this so everybody understands what we're looking at here. Okay. So at the beginning of the year, the expectation is that the benchmark interest rate would be somewhere between 3.5 to 4% by the end of this year. Just for excuse me, um, just for context, the current benchmark rate is around 5.25, 5.5%. Okay, so we're talking somewhere around a 1.5 to 2% cut, which initially was 6 or 7 cuts this year. One quarter passes. Now the expectation is that by the end of the year, this is more so where we're looking. The interest rates will be between 450 and 500, so 4.5 and 5%. That's a 1% shift in the expectation. Just for those who do not follow Federal Reserve policy meetings, one interest rate move is 1/4%. So this is 4 movements that in one quarter the market says, okay, never mind. We expect you, instead of to make 7 moves, you're gonna make 3 moves. or instead of making 6 moves, you're going to make 2 moves. That's a pretty substantial shift just within 3 months. And this is coming on the heels of essentially, Jerome Powell, when seeing inflation numbers, when seeing the strength of the economy, policymakers are basically saying we got to hold rates where they are, because if we bring them back down like the market wants us to do, we're going to go right back to where we were, which is an overheating economy with an inflation problem.
And typically, in an election year, um, doesn't matter who's in office, but you'll see a lot of pressure um, on the Federal Reserve to push interest rates down to keep the economy moving.
Yeah, yeah,
And we may not see that, and that rarely happens that they don't um, relinquish to that. So um, because they are a political appointee if they want their job the following year, after during a new regime, or a second term. Um, they'll typically relinquish that and push it down a little bit, and then that following year pop it back up.
right.
But it'll be interesting to see whether Jerome Powell, see where his strength is here.
Yeah, yeah. We got I guess this is a comment on unemployment and the labor market. Which, Rick, I don't know if you want to, we can comment on this, but I'll read it out. Unemployment is low. A large number of people have left the workforce. Government workers have been hired that contribute nothing to the bottom line, i.e., GDP. In fact, the deficit. I touched on it briefly in the commentary, but we can circle back to that. Just the cost of groceries are through the roof. 2/3 of working citizens are living from paycheck to paycheck. Um, I, you
Yeah.
know, I'm gonna just let me check this off here. I think that is a apt analysis there. One thing I would note is that unemployment figures are low, and I do think that unemployment often gets politicized in a lot of ways. Um, but I think the other thing to think about in terms of labor market strength is jobs numbers, right? So how many new jobs are being posted, and those continue to exceed expectations as well. Wage growth has continued to be strong. Um, I think that it's not to say unemployment is fictitious in that you have people that have exited the labor force, so maybe it's not as good of an indicator as it once was. But I think jobs numbers are one thing that is kind of spooking central bankers to say, okay, there's still a strong labor market.
Well, the Inflation Reduction Act
Yeah,
was actually a more inflationary than it was a reduction in inflation, because
yeah,
they actually it was an infrastructure. A lot of it was infrastructure. Part of that came from the CHIPS Act, which basically requires government to hire a
yeah.
substantial amount of people, on developing and building out infrastructure, on support of that infrastructure. And a lot of these jobs are coming with a much higher than typical minimum wage as well. So if minimum wage goes from 7.50 to $15, which it has, I believe the federal minimum wage technically is still 7.50, but they're not
Right.
paying that kind of money. They're not paying 7.50. They're paying technically into the 15s to the 25 range on their employment.
Mm-hmm.
So that in itself is inflationary. Um, and with the food prices, they tend to get removed from the CPI. Food and energy
Right.
gets removed from the CPI,
Right.
which we still feel that when rates go up, when food prices go up, and and gas prices go up, we still feel that, because that goes hand in hand. When gas prices go up, food prices go up because you're transporting the food.
Yeah, and I
Um,
and I think that goes exactly to what I was saying with what consumers see. And gas and groceries are, not necessary, not really lifestyle expenses,
yeah.
right? You see those as essential expenses, and you tend to compare on an absolute basis. And that was exactly right. You have a lot of working class Americans living paycheck to paycheck, and then they see what's happening at the pump and at the cash register. And even though central bankers and policymakers are saying, "Well, that's volatile. We don't look at it," that tends to be when things like toilet paper shortages during COVID happen, because you get these buying frenzies. And when you get consumers into that sort of a mindset where, yeah, you can tell me it's a 3% inflation. Oh, it's not that much, but I know what my grocery bill used to be a year ago versus now. It becomes very difficult for them to get out of that mindset, because, that's going to continue to stoke goods inflation because they see it and it's tangible, right? Whereas, so you're going to I think you're going to keep having those spikes, I guess is my point. And it's
Yeah,
going to be harder to get it under control.
and when you see food prices and gas prices going up, and then you see entertainment prices continuing to go up, you know that that's not really affecting the economy as much as it should have been,
Right.
because entertainment costs are still going way up. Going out to dinner, going on cruises, going on trips, airlines, um, all has to do with all that increase um, in that environment shows that the increase in food and energy doesn't really hold isn't really holding back the economy at this point in time. Although
Yeah.
it does affect in general, it does and usually should affect the economy.
Yeah, and I
But
think it will. So this is what I think needs to be talked about, because there's a lot of jawboning around all these different topics, and oh, we should pay attention to this or that or the other thing. And ultimately, there's a lot of different viewpoints. A lot of them are maybe right in theory or in practice, or maybe partially right. But ultimately, like it or not, inflation is a problem, um, and a problem that we have not had for quite some time, in the economy. And I think that no matter what metric the Fed is looking at, and no matter and what they're placing priority on, I think it's important to realize that the restrictive nature of the current benchmark interest rate, so the current, let's call it, cost of capital across financial markets, it's only recently, and when I say only recently, I mean like within the past like 2 quarters, so towards the end of 2023, has gone into what we would call restrictive territory, which essentially restrictive territory would mean the um, real cost of borrowing, meaning inflation adjusted. So think back to 2023, when I remember we were doing our quarterly conversations, we're showing those inflation charts with all the colors, and inflation hit a peak of like 9.1%. Well, it doesn't matter that interest rates were zero and now they're three, because if your interest benchmark interest rate is three, but your headline consumer price index is nine, you'll borrow at 3% all day long if things are going to cost 9% more, right? It's not very restrictive. So it doesn't really matter what rates are today versus what they were yesterday. What matters is what are rates today compared to what the rate of inflation is.
yeah, and
And
when you talk about that real Fed funds rate, that real rate today is 5.25, and then you talk about minus inflation. So that real Fed funds rates right now is 5.25 minus 3 is 2.25 at
two,
this
two and
point
a
in time.
quarter, right?
Yeah,
Exactly. So that's positive, right? Meaning that in theory, if you're going to buy a good or a service, it's more capital efficient for you to use cash rather than to borrow. And I think the important thing to realize about that is really to be if we go back and we look at where we've been, that really has not been the case since prior to 2008. I mean, that was really the last time we crossed over this threshold of 2.25. And what you'll see is there's a couple of phenomenons going on in this chart here. Every time you get over that threshold is typically later in the economic cycle, which makes sense, right? Because you're in a part of the cycle where there's a lot of growth going on. They're trying to kind of slow down the bus, so to speak. And it usually happens before you hit the recession because this is what the conditions look like late in the cycle. And I think it's important to realize, even though we've talked about things like the inverted yield curve, which is shown by the blue, anytime the blue line dips below the zero, that's when it's inverted, which we always talk about. That typically precedes recessions as well. And you can see the same thing in this chart. That these are typical characteristics of a late inning economic expansion. But even though we've had an inverted yield curve for what did we say, 18, 20 months, something like that, Rick?
We're on 21 months.
Yeah, the restrictive borrowing conditions relative to inflation have really only just begun. So I think this is one of the reasons that you're seeing the Federal Reserve kind of hitting the pause button and saying, you know what, we're going to keep rates where they are right now. We're not confident enough yet that inflation has subsided. Now, they could certainly thread the needle and not keep the rates high for so long that it creates a recession. It's certainly, possible. But again, as you can see, typically when you hit the end of a cycle, the rates will stay high and eventually a recession hits. So you see all these plateaus here where rates stay high and then eventually you hit these shaded areas, right? There's movements, certainly by no means an exact calculation, but that tends to be the trend. So we're still in the early stages of this restrictive rate policy, and we do believe that rates will come down, but probably not as fast as the market is thinking or the market would hope.
Unless something big happens.
Yeah, and I think this is another thing to realize. This is a shorter term chart, but the other thing over the last 2 years, leading economic indicators. One of the reasons that we've still been talking about the late inning expansion. When does the recession happen? Leading indicators have mostly been negative for the last 2 years, and actually for the first time have turned positive. So this is actually a very good sign that again, like we talk about with corporate earnings and valuations, hey, there's actually some real fundamental reasons that US stocks are trading at high valuations. There's real fundamental reasons that the Federal Reserve is justified in keeping the cost of borrowing high. Real fundamental reasons to actually look at, even though again it's a mature stage of the economic cycle, to look at this as a positive thing, because the economy and the leading indicators on the economy are actually fairly healthy.
Yeah. Let's talk about leading indicators for 1 second. When we talk about leading economic indicators, we typically, when we're talking to people on the phone or when we're talking to one-on-one, we're talking about home sales. We're talking about consumer spending or the CPI. We're talking about construction permits or manufacturing or employment figures, and GDP. All those combined together are leading economic indicators. And it's important to know that because the Federal Reserve weighs those based on what's pushing inflation. And right now, the GDP is the biggest the most important economic indicator. But to the Federal Reserve, it's employment is the biggest economic indicator right now, specifically.
Right. Yeah. So I think this is important. There's actually, there's some real strength behind, why we're seeing strength in the markets. why we're seeing persistent inflation and GDP growth. I mean, these all look like positive things. I think that one of the themes of what I continue to talk about is, obviously there's the possibility of recession. There's also the very real possibility that that is several years out, a year, two, three, and the market continues to grow, even if it is low to mid single digits. But we're getting the question of, well, all of a sudden we're getting, 5.5% on CDs. We're getting bond yields of 4.5%, which, by the way, um, a, the yield on a 10-year treasury of over 4%, that has not been something you can get in over 15 years.
except
So,
for one day about 2 months ago, 3 months ago.
well,
It
correct,
hit
correct. And
five
I
percent.
and I think that that's something to keep in mind is, we've heard that of we want to wait for it to come back. And, I think, these interest rates tend to move in cycles, and we are at the peak of the cycle, no matter how you look at it. The important thing to realize here on bonds. So this I said in the beginning, we think that bonds are back as ballast, and there's a reason to like some of the bond market right now. One of them is simply what is a fairly long-standing correlated relationship. If you look at, and now this is just aggregate bond market, I think typically this is represented by about a 7 to 8 year maturity duration in the aggregate bond market. Whatever the yield is at the current date, right now we're at about 4.5%. And then the subsequent returns over the next 5 years on the bond market. So, in other words, you take whatever that yield is, call it today 4.5%, you buy the bond market, call it index or a fund or what have you. Typically, over the subsequent 5 years, your returns are usually at or above what that yield is on the date you bought it. Now, of course, there's volatility in these bond funds. As interest rates move, prices can move. So it doesn't mean in a given year you're going to be up or down, but typically over a 5 year period, there's a very positive correlation between starting yield and the next 5 years. Not a perfect correlation. We can see there are some outliers where you have these data points falling well below the line, where started at a 2.5%, started at an 8% bond yield. I'm trying to draw a little box here, but started at an 8% bond yields, these guys right in here, and you ended up with, whatever, between 2.5 and a 5% return over the next 5 years. But the vast majority of these, your starting yield typically means you're going to get at or better over the next 5 years. This tends to be a really compelling argument, especially when you're at the end of a rate hike cycle, right? Because bond price is inversely correlated with yield. So you want to buy the bond before the interest rates go down, because then the bond is worth more later. And that's the idea with this chart, is that bonds appear to be a more attractive proposition than they were prior to the Fed rate hikes, in 2022. Now that interest rate policy has sort of stabilized, this appears to be more attractive.
But to capture that return, technically you got to sell it. For instance, that 10-year
Yep,
bond went up
sure,
to
absolutely.
5%. Yeah, we went up to
Absolutely.
5% a few months ago on that 10-year for one day. It was paying a coupon of 0.375. So
Yep.
the only way you're going to capture that is when that drops down, is to sell that bond
Right.
and capture
Or
that return.
again, to buy a fund, and when it drops down, your asset value will appreciate.
We'll appreciate, yeah.
So that's important to realize. Now, I'm just gonna go, but this can get a little bit complicated, but it's a very simple message, and we have probably a bit of a simpler chart to sort of wrap things up here. I said 4.5% starting yield. And let's say that the typical relationship, again, that subsequent 5 year return is you typically get at or better than that. Um, and let's call that our base case. That's what we think is going to happen. Well, if you go back to what I said right before we talked about the market, we said low to mid single digit returns on the stock market, US stock market over the next 5 years.
Yep.
So we all know how volatile, especially recently, the market has been. Now, so is the bond market. So that's not to excuse bonds, but we all know how volatile the stock market can be. Uh, if we are expecting low to mid single digit returns in stocks,
On
and you're
average.
on average, and you're expecting, say, low to mid single digits on bonds, it's a pretty easy question. But what's your risk adjusted return? Meaning, how much extra return are you actually getting for that extra risk you're taking in stocks? This is something called the US equity risk premium. This kind of an academic thing, but essentially this is looking to uh, uh, quantify just that. And what you'll notice is it's crossing over into negative territory, which essentially means when it's negative, bonds are more attractive. When it's positive, stocks are more attractive. Essentially, it's saying for that extra risk you're taking in the stock market based on expected returns, you're getting compensated for that extra risk. I think the interesting thing about this chart is it says a lot about the economic cycle you're in, because we often, when we go through these quarterly conversations in economic and market history, we talk about these different periods, right? What was happening in the 70s and 80s, what was happening in 2008, what was happening in, the dot-com bubble in the 2000s. You look at this and you see really, I think, two distinct markets and two distinct regimes. You see 70s, 80s, 90s, and you see 2000s, 2010s, right? You got 4 decades there. First two, 80s, 90s, call it tail end 70s, you're dealing with inflation, you're dealing with volatile interest rate policy. You went off the gold standard, which is, just another currency manipulation. Bonds more attractive than stocks. Also, interest rates were much higher. You get into the 2000s, you have tech stocks, right? The technological revolution. You have cheap capital, right? You have a recession in there, big one, 2008. But technically, equity returns have been great. Cost of capital has been near zero. Inflation has been mostly non existent. This is interesting because this is the first time that this has really crossed over that threshold uh, in over 20 years. And I think this goes to show two things. One, this is the effect that inflation has on trading capital assets, number one. But number two, just not to be lost on anyone. I mean, this was a historically steep interest rate hike.
Yeah. Very
And that
historic.
has really thrown the sort of the risk premium, just turned it on its head. So I think it'll be interesting to see if this persists. But um, that's what this is. That's what this is attempting to chart over time. And Rick, I'll let you go through this. This is the really, as of today, if you think about the asset class return estimates, this is sort of where the rubber meets the road, looking at what that really means, that equity risk premium, what it really means for portfolios.
Yeah, and it's interesting because we've been saying this, I think, for the last year, since interest rates have been up as high as 5%. Why take the risk? And Liz Ann Saunders came out, I guess, about a month ago with a video that she was talking about where the market can go, where the economy could go from here. And basically, her bottom line is it's unpredictable. It can go up or it can go down. And they looked at a couple of different scenarios going all the way back to 1929. And it was basically unpredictable. But if you flip back to that last chart for half a second, Dan, you look
Sure.
back to 1982, and that risk premium in bonds has or equities have has gone way down, or the equity risk premium dropped below the average. And the the late 80s
Uh-huh.
and 90s, the
Okay.
market's done fantastic. All led by computer development and internet development, and then
Yes, yes.
so you could be wrong, but the
Sure.
bottom line, going back to the next one, what's predicted or what's expected out there with our current increasing interest rates that we have, which basically slows down the growth of the economy. And if we stay where we are in a slow growth economy, that's why we're projecting single digits, because the companies have to get used to a higher rate of interest rates at this point in time. I was talking to a guy just yesterday. He is a he owns a one of the larger um, um, architectural firms in Philadelphia, and one of the firms that he does development for is multifamily homes. And he came back and said, you know, Rick, as soon as interest rates started going up, everybody stopped developing. And he said, I don't think interest rates are going anywhere from here. And I agree with him. I don't think they're going to go down where they were. And he said, but they can't stop developing forever because they only way they make money is to develop. So they have to come up with a better way to do it. But I think, like Dan was saying, Dan, you were talking about, over the next 5 years, it could take a little bit of time for that to continue to grow. So when you look at the difference with investment grade, the base investment grade bonds, we're looking at 4.6% on that return. When you look at the base large cap stocks, you're looking between a -4 and a +4, or -1 and a +4.5. Why not be in bonds? Why take the risk? Yes, we have an upside of 9.2, and yes, we have a downside of 8.5, but why take the risk? I
Yeah.
think we do take the risk to a point, but we don't be unrealistic with that risk when we're getting 5% on bonds right now, 4.6 on average base. Why take that risk of, maybe stock prices will go down? I don't know. But we do believe with where interest rates are today, and the economy has to get used to that interest rate environment unless something blows up. And remember, there's still um, office space out there that has not turned over yet, and we have a large midline group of banks that hold a lot of that office space. And if that turns over, that could blow up some banks. That could push the economy down, and that could create lower interest rates. But if they can hold on and hold their breath long enough, then this could play out to the fact that we remain at a base case single digits on our equities with a 4.5%, 4.5, 4.6 to 5% on our individual bonds with
Yeah.
the
So
allocation.
I'm going to stop the share there. If anybody has any questions or comments, feel free to put it in the chat or the Q&A. And just to wrap this up, I think like Rick said, going back, looking at that chart in the 90s, of course, the market did extraordinarily well just because the risk premium is not necessarily there. Doesn't mean we can't or we won't get returns in the market. And again, looking at that upside, sure, even if you can get 5 or 6% in bonds, if you can get 10, 11, 12 in equities, we still think that strategically long-term assets, you still want to stick to your allocation. You still want to stick to, the risk that you're comfortable with taking in the portfolio, for several reasons, but not the least of which being most of the indicators are showing us that there is economic strength. That should there be a recession, obviously we can't time things perfectly, but that at least at this point in time, there's reason to believe that it would be mild, and that over long periods of time, the market tends to grow. It doesn't mean that we're going to be able to make a quick buck, but I talked about this in the last letter. Usually when the market hits new highs, it hits a lot of new highs in that year. That just tends to be the trend. So um
which I think
I
we just came off of.
yeah, and I think that that's important. So, most of what we're saying is right now we want to stick to the long-term strategic allocation. We want to be cognizant of maybe more than ever what short-term liquidity needs there are, because the bond market does appear attractive. So to the extent that you can really define what those short-term needs are, you're actually getting compensated to not take risk on those short-term needs. But long-term money, and this should be no surprise to anybody knowing, that knows how we think, should still be invested in the market, should just be done so in a way that is geared to protect the downside, is geared to perform well in times of economic turmoil, and has very strong fundamentals, very strong cash flow. And we believe it'll benefit, those types of companies will benefit in the next regime once that the rally starts to broaden out. So I don't see any additional questions, and we
All
we
right.
are at 5 o'clock. So
So, well, it's time to close. And Dan, again, you put together a great newsletter, and a great presentation. And hopefully, everybody was able to get a little bit of something out of that. We know we talk about this all quarter long, but we hope we're able to provide some education and understanding of our thinking.
yep, absolutely.
So
Good to see everybody. Thank you for attending, and we will talk to you soon.
thank you very much.
Bye bye.